Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. On today's show, we've got Dan Dreyfus of Bornite Capital. He started his fund during the pandemic and he used to work at 3G and Goldman Sachs. He runs commodities, and right now he says we are seeing a major structural change in the market. Regardless of tariffs, he thinks that a regime change is underway that's going to benefit commodities for the long term. He thinks gold could hit as high as $4,000 an ounce. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. If you're a do-it-yourself investor, BMO InvestorLine Self-Directed is the perfect platform for you. With powerful tools and commission-free trading on over 100 ETFs, you'll have everything you need to take control of your investments and build a portfolio that's right for you. Learn more at bmo.com/investorline. Dan Dreyfus of Bornite Capital, thank you so much for joining me.
Amber, it's great to reconnect with you and congratulations on your show.
Thank you. And I'm looking forward to getting into it with you because I've known you at various iterations and stages of your career. But you started this fund now 5 years ago, Bornite Capital. What is Bornite?
Bornite is a host rock. It hosts, it's a big host rock for copper, which is one of my favorite metals structurally. Originally, I actually wanted to call the fund the Kimberlite Fund because that's the host rock for diamonds. And obviously diamonds are the most valuable mineral commodity. But that name was taken. So I went with my second favorite, which was copper.
So that really tells us where your bent is, right? I don't know many people who have a favorite metal like that. So obviously you're focused on commodities.
Yes, we're focused primarily on infrastructure and commodities. We also invest in consumer and TMT related companies, but I would say our expertise really lies in the infrastructure and commodity area.
So I mentioned you started this fund, was it in 2020?
It was.
So that was like, what was that like? Wasn't that, it was either a terrible time or an amazing time, depending what month in 2020.
Yeah, it was an interesting time to launch. Obviously, in January, you started to see all of the COVID headlines hitting. And I remember back from the 2000s when the original SARS virus hit and they shut, Canada was impacted. They shut down a bunch of the airports in Canada, a bunch of the airports in Asia, some of the airports in Europe. And we thought, okay, well, if this is another run-of-the-mill SARS virus and they have to curb travel, then that can't be good for travel demand and energy. Just, we took the playbook from the first SARS virus. This one, SARS-CoV-2, was obviously dramatically bigger than the first one, but we didn't know that. But typically when we see a headline where that headline on page one of the newspaper can turn into a real risk that can create losses in the portfolio, we go and scour the universe to try to find really cheap insurance to protect us against that. Sometimes we find it, sometimes we don't. In this case, what we said is we knew that it would hit oil demand, it would hit travel demand. And so we actually went and shorted the credit of a number of oil producers, airlines, a number of industrial manufacturers that we knew were tied to industries that would get hurt if there was just a mild slowdown. We had no idea how big COVID was going to be. And it turned out to be the big one. And that insurance policy that we bought paid off in spades. And it allowed us to be profitable in January, in February, in March. And when things crescendoed in March, that's when we covered this tail hedge and covered our credit shorts, reinvested our profits into what were some pretty beaten down stocks, some of which were our favorite names. And 2020 turned out to be, I would say, a very good year.
So that's amazing. You almost perfectly timed that because it was super awful and then it was super amazing. So you're able to go long and short. And while we're in a different period of time right now, we're not talking about a global pandemic, but we are worried about a global crisis in the form of tariffs. And whatever form they take, there's anxiety about just the fact that the US is taxing and tariffing its trading partners, and that has all kinds of implications. So the markets, aside from gold, which we'll talk about, have sold off into this event. Tariffs are going to come to fruition. Everyone's going to have to deal with that. So how are you positioned maybe going into this event? And how do you think about positioning broadly coming out of it?
Well, with tariffs, we're effectively balkanizing the world's supply chains. Everybody wants to build their own factories in their own backyards right now to get around tariffs. And industrial production, the ultimate result of this, or the end game, and which is what's trying to be accomplished here, is industrial production is going to be moving from low cost manufacturing bases to higher cost manufacturing bases. And what that means is it just means everything is going to cost more. It's going to be highly inflationary. The value of your money is going to continue to be slowly destroyed, as it has been now for the past 5 or 6 years. And so with that backdrop, that is a pretty good moment, I think, a port in the storm in this kind of backdrop to protect the value of your money as it's getting eroded by this inflation as we balkanize the world's supply chains on the back of these tariffs. Infrastructure and the critical commodities that we're going to need to get the world to where we want to be, they're going to protect your money. I also think, Amber, and I'll spend a minute on this because I think this is incredibly important, that putting tariffs aside for a second, I think we're going through a very important regime change. And historically, we've actually been pretty good at identifying the big regime changes over the past couple of decades. And I think we're entering a big regime change right now. If we roll the calendar back to pre-COVID at the end of 2019, just to level set what we're talking about here. At the end of 2019, US GDP was roughly around 22 trillion, and US federal debt was also roughly around 22 trillion. Over the next 5 years, through COVID and the ensuing years right until Trump got elected, debt grew from 22 trillion to 36 trillion, so an increase of $14 trillion. GDP, however, which also started at 22 trillion, only grew to about 29 trillion, so a $7 trillion increase in GDP, but it took $14 trillion of debt to help us get there. Now we're entering into a more austere fiscal regime where, the government, the Treasury Secretary, Trump, everybody is trying to take this deficit, which is running at 7% debt to GDP. Their target is to get it down to 3%. And if funding fiscal deficits, if they were occurring in any other country, this would be described simply as fiscal austerity. And so we're transitioning from a world of fiscal largesse to a much more austere world. And government alone, if you look back over the last few years, government was responsible for creating 84% of all jobs came from government in the past couple of years. Then you layer on what's going on with immigration. Immigration, which under Biden averaged between 2 to 3 million people per year. Prior to COVID, by the way, that number was below 1 million. But for the past few years, it was averaging between 2 to 3 million people coming into the US per year. Now, if you look at the numbers, that number is going to be well below 500,000 coming in 2025. And you go back and you look what immigration contributed to GDP over the past few years, and it was about 150 basis points of GDP contribution from immigration. And so putting it all together, what that means is when you take the surge in immigration coupled with the substantial government spending, overspending that we've had in the past 5 years, that was the entire GDP growth. And we're reversing both of those right now. We're trying to cut the deficit, and we're significantly reducing immigration. Then you layer in the tariffs on top of that, which is effectively a big sales tax. And this is a moment in time where I think you have to take all of this into account and accept that it has changed the risk profile of many, many risk assets. And my conclusion, and I'll stop here, my conclusion is that infrastructure, investing in infrastructure, is going to be a very safe port in what could be a potential storm.
And I don't want you to stop there, because that was such a crystal clear explanation, and kind of a sobering one without emotion, right? You're just looking at the facts. We are entering a period of slowing growth, but tariffs, as you mentioned, act as a mechanism to increase prices. And so slow growth plus higher price increases equals stagflation. And so I wonder how you take the facts of how you see this structural regime change taking place and implement that in the portfolio. What's the so what for investors? And I'm curious, is gold reflecting some of this so what? Is that why gold is at a record high, and how much higher could it go?
Yes. So to answer your question on gold, gold is sniffing this out for sure. My view on the gold market is that it was always going to be a 3-phase bull market. The first phase, we've been in a bull market for over 25 years now in gold. And the first phase was that move up from 500 or 600 up to 2000. That was phase one. Phase two was the consolidation phase. And during that phase, gold traded as high as peaked at 2000. That was the peak. It traded as low as 800 and oscillated between that range for a very long time. And my view on phase three was that when we broke through that prior peak of $2,000, that would be when gold would find its equilibrium level. And my view was always gold's equilibrium price was somewhere between $3,000 to $4,000 an ounce. And I get there simply by taking what the federal debt was prior to the big financial crisis in 2008. And my view is always gold should track the percentage change in US federal debt. And if you track the percentage change in US federal debt since pre-GFC through today, that would get you a price in the higher mid to high $3,000 range. So I think that is the equilibrium price for gold. And the catalyst that started this big breakout was just the big debasement of the currency. It started post-COVID when we clearly overstimulated and added $17 trillion to the federal debt, $14 trillion to the federal debt, taking it from 22 trillion pre-COVID to 36 trillion. That was the first driver of the breakout. And I think the next leg of the bull market is going to be the realization that tariffs are balkanizing global supply chains and making things and manufacturing things in expensive industrial bases, which is what tariffs will promote, is simply going to make everything more expensive, and it will destroy the value of your currency. Everything's going to look the same, but everything is going to be more expensive, and therefore the measuring stick on which you use to buy those things, which is the dollar, gets devalued, which benefits gold, and not just gold, other commodities that are critical to where we want to go as well. And not just those commodities, but also hard infrastructure that's already been built in the ground that's difficult to replace. That will also protect you against what's coming.
So we're going to talk about what those are and how you express that through stocks. But just to go back to gold, which is around $3,100 an ounce, you see upside to $3,500, maybe even $4,000 an ounce. You also said, though, that it tracks debt and that the administration is laser focused on bringing down those deficits. So I wonder, is there a downside risk? Like, what if they're successful in bringing down those deficits? Does that not argue for a lower gold price? Though you also mentioned inflation, so does inflation switch? Does inflation carry it higher even if those deficits come down?
The objective of the administration is to get the deficit from 7% roughly of GDP today down to 3%. And so if GDP is running at around $30 trillion, we're going to be adding $1 trillion to our debt effectively every year going forward. So the debt's going to continue to rise. It's just going to continue to rise at a slower pace. Now, my price target for gold in the mid 3000s is based on where it should be trading today, based on how much the debt has already increased. Now, if somehow we can figure out a way to cut our federal debt, which I think is basically impossible because there's so much non-discretionary spending that simply can't be touched, then maybe I would have to rethink where gold could go. But I think we're just moving from a world where debt was rising at an unsustainably fast pace to now it will simply rise at a normal pace. And when you layer in the inflationary impact of tariffs, I think that really supports the gold price in the mid $3,000 range. And then from there, it can start appreciating at a more normal rate. But I think this breakout move from 2,000 to 3,000 today, probably going to 3,500, I think that at that moment, the bull market will slow down in gold.
So I want to ask how your view on gold and generally your worldview has evolved. You know this term, people who are perennially bullish on gold for structural reasons, they get labeled gold bugs. You mentioned, when you started your fund, you weren't dogmatic, you were nimble, you were short, you were long. Have you been as nimble around gold as you were on other areas, or are you a gold bug?
No, I view gold as probably the best form of currency. I view gold as a currency, not as a commodity. And in a world where we are continually debasing currencies, I think gold, for me, became a mandatory investment that I had to have in part of my portfolio. It became mandatory as long as this was going on. And we just keep getting more and more examples of potential future ways of ways that countries are going to debase their currencies. I mean, if you saw that interview where J.D. Vance went after Zelensky, that 10 minutes of back and forth between J.D. Vance and Zelensky is going to do more to remilitarize Europe than 40 years of the Cold War. Now, how is Europe going to rearm? That is going to require substantial deficit spending. So, the euro was once viewed as an austere currency led by Germany. You can throw that out the window now. That's not going to happen anymore. And in a world of government spend that just simply cannot be stopped, I think having some gold in your portfolio is mandatory. And that's been our view for the last 25 years. My very first job in this industry, I got into this industry. I was lucky enough to get a summer internship at BMO in Toronto in the summer of 1997. And I was working in the equity research department for the gold mining analyst. So I have a very, very long history with gold. And ever since I got into that business in 1997, in the summer of 1997, gold was trading at $300 an ounce. And today it's 3,000. It's 10x'd from day one of my career to today. So, I wouldn't call myself a gold bug, but I look at the facts that are out there. And until they change, I will continue to be long gold.
All right, well, let's see if we can find some of these opportunities and dip into the mailbag. Okay, our first question, speaking of, you said one of your bents is critical infrastructure. First question is on South Bow. Does it make sense to buy, sell, or hold right now? This question coming from Jeff. And, over the past couple of months, South Bow's done well. It's held up well. The stock's up 9%. It is a spinoff from TC Energy, and you've got that pipeline infrastructure.
Yes. So South Bow is the Keystone Pipeline. TransCanada spun it out. You're correct. They wanted to become a pure play natural gas pipeline company. They felt that the Keystone Pipeline was depressing their multiple from the lens of an ESG investment standpoint. And so they spun it out. We love spin-offs because they tend to come out very misunderstood and a lot of the time very cheap. And in the case of South Bow, I think it's your textbook spin out that's misunderstood, cheap, and orphaned. And it has the added benefit of being the perfect kind of investment for this regime change that we just discussed. Because they take their tariff, which is roughly $8.75 per barrel, whether the oil flows or not. So the oil pretty much always flows. The only time it really didn't was in COVID, when there was that extraordinary situation where producers had to shut in for a little bit. Other than that, the oil will always flow on the Keystone Pipeline, whether we're in an economic boom or a big economic recession. South Bow will capture, the Keystone Pipeline will capture that $8.75 per barrel toll that they receive, no matter what happens in the economy. And so we really like that. Now, where the misunderstood part comes in is their competing pipelines, Enbridge's mainline and the TMX pipeline, they have inflation escalators built into their contracts. And here is the nuance that makes South Bow very interesting. Is South Bow's contracts come up for renewal around the 2030 timeframe, some in 2029, some in 2030, some in 2031, but call it 2030 on average. By the time those contracts come up for renewal, TMX and the mainline will be pricing their tolls somewhere around $10 to $11 a barrel versus $8.75, where South Bow is pricing theirs today. And so what that means is when they come up for renewal, they can increase their toll up to the market level for zero capital outlay. That's just free EBITDA they're getting. Now, while you're waiting for that to happen, they're doing some quick hit, high IRR, low capital intensity projects that's going to increase their EBITDA while we're waiting for that recontracting to happen. They're also going to be generating some excess free cash flow after they pay their dividend. Once their dividends are paid, there'll be some cash flow left over, which they can pay down debt and reduce their interest expense. And so when you add up these three drivers, lower interest expense, quick hit projects that are going to increase EBITDA, and then a repricing of their toll around 2030, what that does is it increases their earnings power, their free cash flow generation by 60%. Now, if the multiple stays constant and the earnings power increases by 60%, then you can figure out what that means for the stock. But it gets better because they pay a 7 or 8% dividend. And so if you wait through 2025, 26, 27, 28, 29, you sit on it for 5 years at 7, 8% dividend, you're making 35 to 40% of what you're investing today. You're getting a 35 to 40% return just from the dividend. And the cash flow grows by 60%. So you add the dividends of 35 to 40% plus the cash flow growth of 60%, assume the multiple stays constant, then you add those two numbers up and you can see where the stock could go over the next 4 to 5 years. And the beauty about this thesis is I don't need to make any macroeconomic call. The tariff announcement could come out today and he could say tariffs are 30%. That won't change South Bow's earnings by a penny.
Okay, so it sounds like, I think one of the things people lament about South Bow is like, yeah, what are those near-term catalysts as it finds its footing as a new company? But your time horizon is interesting, that you want to wait through those 5 years and that it can weather the tariffs. One thing we know specifically about the Keystone is that it can get very political. And while there's politics at play in the US, I'm wondering, as an investor in South Bow or any of these pipeline infrastructure companies in Canada, this is a hot topic as well as we head to a federal election, specifically around this bill called Bill C-69, which many have labeled the anti-pipeline bill. So you have, Prime Minister Mark Carney, who says he wouldn't repeal that bill. Conservative candidate leader Pierre Poilievre saying, absolutely, we need to be building pipelines. Quebec saying doesn't matter what it is, it's not going to happen in Quebec. But, how do you think about politics? Do you think that there's a catalyst opportunity around Canada's election in some of these pipeline companies?
So my best investments have always been the ones where there hasn't been a catalyst. I always like to say, when it comes to investing, a watched pot never boils. And so buy a great company that has very visible cash flows that are recurring, that can be protected in an economic downturn, that pay you, in this case, a 7-8% dividend just to wait, and just wait for the cash flows to grow by 60%. Keep that multiple constant. That's your equity appreciation, and you'll get 35 to 40% additional on top of that from the dividend. And you don't have to worry. You can sleep well at night. Now, with respect to the political situation in Canada, you mentioned there was a lot of controversy around Keystone. That was the Keystone XL expansion. That didn't happen. That became a dirty word. That is why TransCanada actually spun out South Bow. They just didn't want that association. They thought it was depressing the multiple of the parent company. And to me, I look at that and I say, that's their moat. That's their moat. If Keystone was such a dirty word and you can't build these pipelines, then you have an incredible moat because the oil has to flow. What's another moat? Another moat was the cost of building the Trans Mountain pipeline. I think the cost was well over $30 billion. And that's why they have to charge these huge tariffs to try to recoup some kind of return on that capital. South Bow has the steel in the ground already. It's already permitted. The oil is flowing. You don't need to spend $35 billion to build a greenfield pipeline. And if you do build another greenfield pipeline, I can tell you right now that the toll will have to be probably somewhere close to $13, $14, $15 a barrel. Again, the Keystone pipeline under South Bow only charges $8.75. It gives them a huge amount of pricing power. If there was another pipeline that were to be built, they could underprice it and effectively take all their incremental volumes. Now, what do I think is really going to happen in the real world? I think it's too expensive and too hard to build a greenfield pipeline. So what we're going to do is take the existing pipelines and find ways to twin them and expand them and do some brownfield expansions to increase the flow on the existing infrastructure we have. And that, for South Bow, is an incredibly positive scenario. And by the way, we haven't incorporated any of that upside into the math that we just walked through.
Great perspective on South Bow. Let's get in our next couple of questions here. We've got one on Barrick Gold. For a long time, Barrick lagged the price in gold. It seems to have woken up since the December lows. The question is from Stephen. Why has it had those subpar returns relative to gold bullion? This is coming from Stephen in Aris, Ontario. What do you have to say to him?
Barrick was my very first assignment in the summer of 1997 when I got my summer internship in the gold mining research department at BMO. Barrick was my first assignment. Back then, gold was $300 an ounce. Barrick stock in US dollars was 20. Now, fast forward to today, we're in 2025. Gold is $3,000 an ounce. It's 10x'd. Barrick stock is 20. So how can it be that the gold price went up 10x and a gold stock, which is supposedly, has leverage to the gold price, is flat? And it's not all gold stocks. You take Agnico Eagle, another stock that I was assigned to in the summer of 1997. The share price was below $10 US, and today I think it's around $110 US, or somewhere in that zip code. So Barrick, the issue that they have was just absolutely horrific capital allocation historically. The projects they built were always over budget, produced less than advertised. Their M&A strategy was disastrous. And so they effectively frittered away a lot of the cash they generated and issued a lot of shares a lot of the time at the wrong moment in time. And this is a textbook case of how you can have a great asset with a great commodity, but just mismanage it. I look at Barrick today. I think that's your question: is where to from here? The past is the past, and I see something pretty interesting. Barrick produces this year; they're going to produce about 3.5 million ounces attributable to them, which also happens to be very similar to what Agnico is producing this year as well. They're both producing 3.5 million ounces. In fact, Barrick should be producing 4 million ounces, but they curtailed 500,000 ounces because of the issues going on in Mali. So, but that'll get resolved, and so they should be at 4 million ounces. But let's say those ounces just go to ounce heaven and just go away. And 3.5 million ounces at Barrick, which is exactly the same as the 3.5 million ounces that Agnico produces. Agnico has a $55 billion market cap, and Barrick has a $35 billion market cap for the same amount of production. And why has Agnico done so well and been rewarded with a real valuation multiple and Barrick hasn't? It's all been capital allocation, number one. And number two, it's been because Agnico operates in safe, good jurisdictions that investors want to underwrite and can get behind. So here's what I think Barrick should do. And I think they can unlock a tremendous amount of value if they did this. Their crown jewel is their Nevada gold mines. Cortez, Carlin, everything they're doing in Nevada is a 60-40 joint venture with Newmont where they own 60%. And so their attributable ounces from that joint venture are around 1.5 million ounces. If they spun out Barrick Nevada gold mines, into a pure play, Nevada-based gold producer with over 20 million ounces in the ground with terrific exploration upside and a management team that was just laser focused on finding more ounces and optimizing the operations, that business would get an Agnico multiple. Why? Because it's in a safe jurisdiction with a tier one asset, hopefully run by a very good management team where they have to promise you they're not going to go and diversify and waste your capital, where they're going to go and explore for more ounces and hopefully give you big returns from $3,000 gold mining gold in Nevada. And if that was a standalone asset, we think that asset would be worth somewhere around $25 billion. If you put an Agnico multiple on the cash flow, the free cash flow that asset would generate if it was a standalone business. And I think it would be comp to Agnico because it's 100% based in the US in a tier one asset. And what that means, if that's worth $25 billion and Barrick's market cap is 35 and they don't have much debt, so we'll just leave that aside for now, then effectively you're buying the rest of the company for $10 billion. And for $10 billion, you're getting 2 to 2.5 million ounces of production with some copper production. With that stub, they can do whatever they want because that's going to be worth dramatically more than $10 billion, even if you put a very discounted multiple on it. So I think that Barrick should be broken up. I think there should be, it should go back to its roots because that's where it is. When Peter Munk created the company, it was based on the big gold strike discovery in Nevada. So I think this is a moment for Barrick. If you're listening, go back to the future. go back, create Nevada Gold Mines and break the company into two and create a lot of shareholder value.
I mean, that's so interesting to hear you talk like that. It's almost like an investment banker or an activist investor. I mean, do you think there's people in Barrick's ears that are talking about that as a potential way to unlock value? Like, what? I guess my question is, like, that's a really nice scenario, but as a shareholder, should I put dollars to work thinking that might happen?
As a shareholder, you should put dollars to work thinking that it won't happen. But if it does, then that's free upside. We love asymmetry. Asymmetry is when you don't have much downside, but if you're around the right things and good things happen, there's an old saying, you got to be ready when luck comes around. And, every professional athlete or anyone who's been incredibly successful in their field, they say, well, it looks like I was really lucky. How was I there in Barrick when one day they announced a breakup of the company and creating Nevada Gold Mines as a standalone unit? Was that luck or was I prepared for that? And so I think you have to have that preparation because right now there is zero value in the shares for any potential breakup. And the stock should do fine if they don't do anything at all.
Just quickly before we head to break, do you
Yep.
have a favorite gold with maybe like less hair on that story? Favorite gold stock?
I wouldn't say there's less hair, but I would say there's way more asymmetry. It's a company called Cheniere Resources. And this is interesting. When Barrick was in its dark days, when the gold price was really low and they had to shut down mines, they decided to shut down the Eskay Creek mine in British Columbia, and they sold it. And why did they shut the mine down? They shut the mine down for a few reasons. Number one, the gold price was low. Number two, the oil price was going up and they were using diesel power to run the mine. And so the power costs were getting very prohibitive. And number three, they had mined a very high grade portion of the deposit through an underground mine. And to mine the lower grade part, they needed to mine it open pit to make it economically viable. And the government didn't give them permit for an open pit. And so they said, our power costs are too high. We can't mine open pit and the gold price is low. We're going to close the mine and we're going to sell it. SKE.TO bought the Eskay Creek mine from Barrick. Now, fast forward to today. What's changed? The gold price is way higher. So that's good. Number two, the power costs. The power costs have come down by 80 or 90% because fortuitously, the British Columbia government built a hydro dam in the vicinity of the Eskay Creek mine. So they don't need to use diesel power anymore. They can use zero carbon hydro at a fraction of the cost. And then number three, they got the permit to move from an underground to an open pit when they restart the mine. And so from here, they've got their financing in place. Blackstone Tactical Ops and Orion Mining Finance have provided the credit and the stream to get the mine restarted. So there's restart risk, but we feel that's been very well underwritten by Blackstone and by Orion. And the one final risk, and this is why it's hairy, is they need the final permit. And that is not a certainty. Obviously, if they don't get the permit, there is no value in this company. But if they do get the permit, and this is where the asymmetry comes in, if they do get the permit, this is a $10 stock in US dollar terms. We think that when they restart the mine in a few years, if they get the permit, this mine can generate around $5 a share of after-tax free cash flow for the next 15 or potentially 20 years on a $10 stock. Now, these companies, 500,000 ounce gold producers in British Columbia, Canada, in one of the best jurisdictions to mine, if you can get the permit, they'll trade at 15 times. And so 15 times 5, you can do the math. The shares trade at 10 today. But you have to understand the risk here is that they don't get the permit and there really is no value in the asset if they can't mine the gold. So that is your asymmetry. A lot of upside, a lot of downside, but way more up than down, and size accordingly. It is very speculative.
All right, we don't like to make our viewers work that hard. So on a $10 stock, you're talking about maybe $75 per share in asymmetrical upside with some risk involved. The ticker on that, for those who want to do their homework, is SKE, both in the US and Canada. Let's take a quick break, and we've got a couple more questions in the mailbag. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, our next question is on Teck Resources. The stock is trading at a one-year low. Would you buy here? This one coming from Leo in Winnipeg. We've talked a lot about gold. Talk to me about copper and whether you'd scoop up Teck here.
Well, copper, and I'm not telling you anything your viewers don't know already, but we only have one periodic table of elements that I know of. And there's really only three metals on the periodic table that can conduct electricity safely. And that is gold, silver, and copper. Now, we're not going to be making our electrical wires out of gold or silver anytime soon. That's way too expensive. And so copper really is the only game in town. You can use aluminum for some lower end uses, but copper really is the safest, most cost-effective and critical way to conduct electricity. And the world is obviously electrifying. Buildings are going electric as you retrofit them and replace the boilers with heat pumps, and cars are over time going more and more electric. Certainly in China, they're going electric much quicker than they are in the OECD countries. The migration to the cloud is very copper intensive because you're building out huge amounts of data centers. Obviously, AI is incredibly electrically intensive. We have to rebuild the grids all over the world, which is obviously incredibly electrically intensive. And that all is going to require substantial demand for copper. There's a view that China is going to have to stimulate if we put big tariffs on them in the US against China. They're an export economy. If you put big tariffs on an export economy, they have to stimulate. There's no other way to offset that significant hit that economy is going to take. And historically, they've stimulated by building huge skyscrapers, and to the point where there's such a huge excess supply of skyscrapers that there's millions and millions of square feet just sitting completely empty. And so if they stimulate, we don't think that they're going to be building skyscrapers like they did in the past. What we think they're going to do if they stimulate is really accelerate and try to improve their position in the AI arms race. And in order to do that, because AI is just a derivative of electricity, you're effectively converting electricity into intelligence. You have to invest substantial amounts of money into the grid, substantial amounts of money into data centers. This is going to be an incredibly copper intensive stimulus that will likely come from China. And so we think the copper price should go materially higher. And everybody's saying this. By the way, I find it interesting that all the major copper producers are saying that there's going to be shortages of copper, significant shortages of copper in the next few years, yet none of them have announced any new greenfield mines. And why is that? The reason is at $9,000 copper, you can't generate an IRR by trying to build a new mine at $9,000 copper. So they all scream and say there's going to be deficits, but they can't do anything about it because when they go to the board with the plans, the management team goes to the board with the plans to build a new copper mine, they say this does not work. And we've done the math, and we think the IRR that is required to get a new mine built is going to need $15,000 copper, up from $9,000 where we are today. And
IRR being internal rate of return, which is the metric that, these companies are using to decide whether these investments are worthwhile.
That's exactly right. And if we run $15,000, which is what we think the equilibrium price for copper will be, And I think we have some credibility in calling what equilibrium prices would be, because we've been long saying that the equilibrium price for gold is between $3,000 to $4,000 an ounce. And here we are. It just took some time to get there, but it was a nice run for the past 25 years. We think the equilibrium price for copper is 15,000. And if you analyze Teck's earnings power at $15,000 copper, they should be generating $7, $8 a share US of free cash flow. The stock today is in the high 30s, and this probably should be sort of a 12 times free cash flow business. So again, I'll let you do the math on that, but I think it's very substantial upside. And if I'm wrong on copper and we don't have any rise in the price, which I don't see how it's possible because we're not going to get any new supply being built unless we do. But if we don't, and copper just stays here, the earnings power is probably around $3 a share. And again, you put a 12 multiple on that, you sort of get to where the stock price is today. So it's fairly valued on spot. I don't have any issue with where it's trading if you believe that the spot price is the right price. But it's our contention that the equilibrium price to develop and what's required to develop new supply, which we're really badly going to need going into a world of electrification and AI, that the equilibrium price is much higher than the spot price.
All right. I know you want us to do the math. Can you give me a percent? What kind of upside are we talking about?
I have to keep you guys awake.
The numbers. I know, right? Okay, like 15, 20%?
So let's say the stock is trading at $37 or so US dollars.
Yes.
And copper goes to $15,000 and they generate $7 or $8 a share of free cash flow. And you put a 12 multiple on that. That gets you mid 80s to mid 90s a share versus high 30s today.
Thank you. So way more than 20%. A double. I can do that math at least. Let's squeeze in two more questions before we get into your pro picks. And we're going to just take a hard left out of commodities into more infrastructure plays, but they're super interesting. GFL Environmental is one of our questions. And I think you own this one. This one's coming from Marcia and Marka. Is GFL a buy at these levels? Waste removal.
Yes. Once again, waste removal and landfills, these are critical pieces of infrastructure. To build a landfill is impossible now. Nobody wants them anywhere near where they live. And it's incredibly expensive with all the environmental permits that you need to get. It takes time. It costs a lot of money. And so when you have this existing network of waste collection, you own a very, very, very valuable piece of infrastructure. And I think for the regime change that we're entering into, that we spoke about at the beginning of this interview, Amber, this is the kind of business that you want to own. Why? Because every year their pricing gets reset by a quasi CPI based inflation adjuster. And so if we're going into an era of tariffs and just structurally high inflation, not crazy inflation, but high inflation, they get pricing power. And garbage collection, much like the Keystone Pipeline, it has virtually no economic sensitivity. You know, people throw out trash, whether we're in an economic boom or whether we're in an economic depression. And so you have tremendous visibility on the cash flows. They are recurring. They are not economically sensitive. They have inflation protection associated with them. And why GFL? You know, there's other waste companies that you could invest in, but we like GFL because they went through a restructuring recently where the knock against GFL historically has been, one, they were much more levered than their peers, and investors did not like that, and they dinged the multiple because of that. And two, they had an environmental services business, which just wasn't as perceived as a high quality of a business as traditional waste collection. And that also hurt the multiple. And recently, they sold their environmental services business, took the proceeds from that, paid down a bunch of debt, which brings them from a leverage standpoint much more in line with the peer group. So the reason for putting a bit of a discount on them because of the high leverage is now gone. And they also got rid, obviously, of the environmental services business, which was hurting their mix from a perception standpoint. It was hurting the multiple having this business inside. And so today, GFL trades at a pretty substantial discount to some of the higher quality peers in the waste business. And this has just happened over the past month, this restructuring. And we think over time, they're going to close that gap. So the bottom line is that GFL is a company that fits our mold for this kind of environment we're in, where growth could be slowing, inflation could be sticky. They benefit from sticky inflation, and they're not exposed to any kind of slowing growth, because at the end of the day, you throw your garbage out in good times and bad. So we like it.
Okay, I got to ask you about this, though, because it's not every day that this happens to the CEO of a public company. In the fall, his home was subject of gunfire, as well as another executive. And then I believe a month later, there were attacks at a GFL facility in Ontario. And I just wonder, like, as a shareholder, does that sort of stuff like give you pause? I mean, we don't know what it is, what it's about. And I believe the investigations are ongoing, but that sort of stuff doesn't generally happen with a lot of companies. And I'm just wondering, like, as a shareholder, when you read that or heard that, what did you make of it?
It's a dirty business, no pun intended. As long as they're operating in a country with rule of law, we make the assumption, and this is why when it comes to mining or any kind of infrastructure, we generally avoid countries where this happens and the company runs the risk of losing the asset. I put virtually next to 0% probability that GFL's assets are going to be lost or impaired in any way. Whatever is going on at the executive level, I'm not privy to that information. But what we're really relying on is that Canada is a great place to do business, and that's not going to change. And those assets are going to continue to be owned by the shareholders of GFL.
All right, great answer. Thanks so much for that. We're going to take a quick break. We'll get back into Pro Picks. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Dan, your Pro Picks, we've talked a lot about commodities, a lot on the metal side, and here you've brought us a couple of energy plays, as well as a mining play. But let's start on the energy side. Cheniere Energy, ticker LNG, so that tells us a little bit about what it's exposed to, liquefied natural gas. Why do you like it here? It's had a very nice run over the past year.
Once again, Cheniere fits our framework of infrastructure, owning infrastructure assets in this kind of macroeconomic backdrop. Cheniere, much like Keystone South Bow, has a take or pay model where the off-takers, the buyers of their gas, the business model is very simple. They take gas from the US, they own the infrastructure that liquefies that gas so that it can turn into a liquid form and be transported, put on a ship and transported. And then that gas is sent to countries all around the world that are short gas. So the US is long gas. Cheniere goes and liquefies that gas and owns the infrastructure to liquefy it. And then that liquefied gas gets sent to countries that are short the gas and need the gas for their power generation needs. And the way Cheniere makes money is they get paid a fixed fee, somewhere around $2.50 an MCF, give or take. And that fee is received on every molecule of gas that gets sold. And they enter into roughly 20-year take or pay contracts that can't be reneged on. And so you have this effective bond-like free cash flow stream that will last for 20 years and will grow as they grow their export volumes. So much like Keystone and South Bow, is the economy can tank and they'll still collect that fee. It's a take or pay. So we love it for this kind of environment where there's a lot of macroeconomic uncertainty. And so the question is, how do you get the growth? Well, here's where I think it gets really interesting. And here's the nuance that I think is being missed right now on Cheniere. Right now, everybody in the world wants to reduce their trade deficit with the US. And the reason for that is they obviously don't want to get tariffed. And one of the most productive, quickest, and easiest ways to reduce your trade deficit with the US, if you're running one, and if you need energy to run your country, is to call up Cheniere and say, hey, Cheniere, can we buy a whole bunch of gas from you and lock into a 20-year take or pay with this big aggregate amount of gas that we're going to buy over 20 years? You sign that contract, you take it to Trump and you say, hey, Trump, look, we've just cut our trade deficit. And it's a win-win because they cut the trade deficit with the US, so hopefully they get tariff less. And two, they get the gas that they actually need. Now, where it gets interesting is historically Cheniere, to get these contracts, they had to sit around the table and compete with the Australians. They had to compete with the Qataris. They can compete with exporters out of Africa. Today, it's a very different discussion. If they're sitting around the table competing with Qatar, Africa, and Australia, and the buyer's sitting there, they just tell the other countries to leave and say, we only want to do business with Cheniere because it brings us the added benefit of reducing our trade deficit with the US that is going to potentially reduce our tariffs. So they have 4 years here where they can go nuts and start signing contracts with very good rates of return. Now, those contracts, because it takes time to build this liquefaction capacity, they won't hit until, the early 2030s. But the nice thing is Cheniere, post the Russia-Ukraine situation, they entered into a huge amount of contracts then as countries stopped buying Russian gas and started buying more US gas. Those contracts are in the process of being ramped up right now. So they're in a hypergrowth phase from an earnings standpoint. We see them doing around $25 a share of earnings, by 2029. But with the new vintage of contracts that they are likely to sign in the next 4 years for the reasons that we just discussed, we could see that earnings power potentially come close to doubling by the mid 2030s.
And on the same multiple?
You're looking at something with potentially $50 of earnings power that should trade at a 15 multiple. It's a high quality infrastructure asset. $750 stock. I'll do the math for you this time. 15 times 50
now
is $750.
I'm doing it. I'm learning. I've got my calculator. Okay, so 750 and it's a 230 stock.
Yeah, and again, no catalyst, Amber. A watch pot never boils. It takes time. But, I pitched this idea at C4K up in Toronto back, a few years ago, back when the stock was around $60. And I laid out a thesis very similar to this, not much different. And today the stock is around 230. So it's, it's almost 4x'd since I pitched it. And I think it could probably 3x again from here if you just sit and wait. And the nice thing about it, Amber, is the visibility to these free cash flows are so significantly high. You're not making a commodity price projection. I see a lot of people saying, oh, well, these oil stocks will earn this much money at $70 oil. Well, that's great if oil's 70, but what if oil goes to 50? Or what if oil goes to 100? You don't really know what they're going to earn. But with these kind of companies where they have, fixed rate take or pay contracts that have 20 years in duration, you can model them almost down to the last decimal. And that's the kind of asset that we really like to invest in this kind of environment.
Well, that's one of three you've brought to us. So let's get some explanations on the second one, which is Talen Energy. And this one's kind of traded almost like an AI stock recently, which has kind of worked both on the upside and the downside. It had a pretty significant pullback in the last couple of months. What is Talen Energy? What is the kind of AI exposure that people think it has?
Talen Energy is a nuclear power producer. We bought it out of bankruptcy. And when it came out of bankruptcy, it traded around $40 or $45 a share. Today it's at around 200. So it's done very well for us as an investment. But we think the assets are substantially undervalued. Their core asset is 2 gigawatts of nuclear power in Pennsylvania. It's a plant called the Susquehanna Power Plant in Pennsylvania. And it's our contention that baseload power that can run 24 hours a day, 7 days a week, 365 days a year, very reliably, and has the added benefit of not generating any CO2 emissions, which is what nuclear does, that might be the scarcest and most valuable commodity in the world right now. You listen to every CEO at the hyperscaler level. They are panicking about where they are going to get their next gigawatt of power. And when you have companies with aggregate market cap approaching $10 trillion panicking on where they're going to get their next gigawatt of power, that's probably a moment in time when you should look at some nuclear power producers, because these hyperscalers don't want solar, they don't want wind. Solar, wind don't generate carbon, but they don't run 7 days a week, 24 hours a day, 365 days a year. Really, only nuclear, achieves these goals.
So do you want to express it through something like a Talen versus buying a uranium producer, which is, those have really pulled back as well.
Yes, we like Talen much better than the uranium producers. Nothing against the uranium producers, by the way. They're probably good, but we like Talen much better. Why? Well, we know what the marker is to build nuclear power generation in the US. The last time 2 gigawatts of nuclear power was built, and again, Talen has 2 gigawatts of nuclear power, so this is actually a really coincidentally good example to give. And there's only one example, there's no other instances of it, so it's the only example to give, was a publicly traded utility called Southern Company did a 2 gigawatt expansion of its Vogtle nuclear power plant. And it took them 15 years to do this and cost them $37 billion for 2 gigawatts of nuclear power. You can buy 2 gigawatts of nuclear power through Talen today. They have a bunch of gas power as well, which is valuable, but just focus on the nuclear for a second. The enterprise value of Talen today is $12 billion. That $37 billion nuclear plant was done with pre-COVID money, before all the inflation, before it cost you $20 to get a latte at Starbucks. And so imagine what it would cost today. Now, there were some cost overruns and inefficiencies, but there always is when you're building these nuclear power plants. So on a replacement cost basis, it's very cheap. And we always like to look at, as you can probably tell, because we spoke about this with gold, we spoke about this with copper, for every commodity we look at, we like to analyze what is the equilibrium price of that commodity required for new capacity to be built. And so in order to do that, we realize that new baseload capacity, the marginal source of new baseload capacity, is going to be gas-fired power plants. And so we studied GE Vernova. We've owned that in the past as well. And we did the analysis, just like we did on building a new copper mine. And we said, in order to generate a reasonable internal rate of return, IRR, on building new gas-fired power, you need about $70, $75, $80 power prices to generate a reasonable rate of return. And if we run those numbers in Talen, I'll save that punchline until the end because I want to give one more quick example. Microsoft, which is looking for power, just like Amazon is, just like Google is, just like Meta is, they signed a deal with 3 Mile Island. Now, you'll remember 3 Mile Island, that nuclear power plant had to be shut down in 1979 because there was a radioactive leak where they had to evacuate all the children, all the women who were pregnant had to get completely evacuated from the area. 3 Mile Island became a dirty word. Microsoft comes and says, hey, let's restart 3 Mile Island. Microsoft Azure, brought to you by 3 Mile Island, coming to a theater near you. Let's restart this. At the time, power prices on the forward curve were trading at around $50 or $55 megawatt hour. They signed a deal, a 20-year contract at $100 a megawatt hour. And so we think the equilibrium price is around 75, but you could get data center deals done at much higher prices. But if we run our numbers at $75 a megawatt hour, which we think the equilibrium price for power is going to be because it costs so much to build these gas-fired power plants, which is going to be the marginal unit of new power, the earnings power of Talen is in the $30 to $35 a share range, and the stock's at 200. And, we think a business like this probably should trade at 15 times. So, 15 times 30, to do the math again, is, 450. It might go to 500.
I'm getting good at this.
But again, this is a critical piece of infrastructure that the world really, really, really needs. There's a great interview with Travis Kalanick on the All In Pod a few weeks ago, and they were asking him about AVs, automated vehicles. And he was like, it just can't happen at scale in places like California, because if we went to 100% AVs in California, you'd have to double the power consumption of California. And the California grid barely works, doesn't even work for what we use it for today. I mean, sadly and tragically, it burns down huge parts of California seemingly every 3 years. 6 years ago, it was Paradise, California that got burnt down. Most recently is LA. And when they do the forensics on the power infrastructure, they find that parts of the grid that caused the problems were over 100 years old. And so we are in desperate need of power and power infrastructure. And if you can buy existing assets that are producing today with the steel and the PP&E in the ground, that are already up and running for a big discount, a fraction of their replacement cost value, that is the kind of asset that you own in this regime change that we're going through, that we discussed about very early in this interview.
Okay, so let's talk about how that fits with Ivanhoe, which is your lone Canadian pro pick here. Base metals run by Robert Freeland, which many people, of course, will know in Canada, and it has been under pressure.
Yes, I think you own that in a size that you can tolerate the volatility, but just own it and take it off your screen. Because I told you in my tech example that no copper producers can add supply right now because they can't make the numbers work at this price. The only company that can add supply economically right now in the world is the companies that are operating in the DRC and the ones that operate at scale like Ivanhoe. And we think that over time, Ivanhoe is going to go from producing roughly 600,000 tons. And to be clear, they only own 40% of that deposit. So it's really 240,000 tons attributable to them. We think that number goes from 600 to 900 to 1.2 million to 1.6 million. It's going to keep increasing by very significant increments, even if the copper price doesn't go up at all. And you get this really interesting volume growth story, but you also get upside leverage to the price. So I think what's really interesting here is that they're going to have volume growth, significant volume growth at today's price. And the algorithm becomes so interesting, because let's say copper is at $4 a pound and it costs them $2 a pound all in to mine it. So they're earning a $2 margin. And over time, you double your production. But let's say, and so if you double your production, I think the share price should follow the volume growth. But at the same time, if I'm right that the equilibrium price for copper is closer to $7 a pound and your costs are still $2, then now your margin goes from 2, which is the $4 price today minus the $2 cost. That's where the margin is today, $2 a pound. If the price goes to 7 and the cost is still 2, now your margin is $5 a pound. So your margins go from 2 to 5. So you 2.5x your margins while you 2x your production. Now, what does that do to the earnings? That takes the earnings up 5-6 times, and stock prices generally follow earnings. So just give it time, size it accordingly, and let the compounding do the value creation for you.
I have to ask, just because we are running out of time, but you're a big jurisdiction guy. You've been talking about that. Are you comfortable with the jurisdictional exposure that you're getting, through the Congo and other parts that they're operating in Africa?
Interestingly, the answer is yes. And that's a very good observation and question that you have because it's the DRC. But interestingly, the answer is an emphatic yes. And I'll tell you why. Right now, I told you they owned only 40% of that mine. The other 40% is owned by the Chinese. And then the remaining 20%, they gave it to the host country. So everybody's aligned. So the Chinese are there, the Congolese are there, and Ivanhoe's there, 40, 40, and 20. Now, the growth projects that they're going to do, it's our view that they're going to partner with a US-based company. And so what that's going to mean is they are very smartly, and Robert's a really brilliant guy. They are ring fencing themselves geopolitically against geopolitical events. Because if someone comes after them for that mine, you're not coming after a little Ivanhoe, a little Canadian $10 billion market cap company. You're coming after the Chinese government on one side. And once they partner on their growth prospects with the US, they're coming after the US government on the other side. Remember when Trump said, or JD Vance said that if you, Ukraine, if Zelensky, you let us run your critical minerals, we're going to send our people there, and that's going to be implicit protection for you. No one's going to touch you if we're there running your critical minerals. If you let us run your uranium and your nuclear facilities, that's implicit protection from the US. Well, this is the exact same thing. If you have the Chinese with a big ownership stake and the US with a big ownership stake, then I think you've ring-fenced yourself very well geopolitically in what might be a more traditionally difficult jurisdiction. And it also has the added benefit, and I didn't talk about this when I was talking about the growth profile, is it actually funds their growth. Because if they sell 40% to an American company on their growth project, that money comes in the door and they can use that money to fund their share of the capital. So it's a capital light growth profile, which is always the best kind of growth profile. That's why royalty companies do so well, because they don't have to spend any capital. So this will be a capital light growth profile where I think they've ring fenced themselves geopolitically in the best grade and best geological deposit of copper that I have seen in 25 years.
Holy moly, Dan, what a great interview. I feel like we got so many unique insights, even if we had to do a little bit of math to get there, but I appreciate it. Thanks so much, Dan.
Thank you, Amber. Great to see you.
Don't miss our next episode. We've got Janine Lee Chung on the show of Waratah. She is well known on Bay Street and she loves her dividend stocks. So if you've got a question on that, you can email us at questions@inthemoneypod.com. And of course, you can send them anywhere you can find us on social media at In the Money Pod. And we'll catch you on the next episode.